picture. We're talking real money.
Well, there's a big question that we're going to try and answer for you today. And why am I speaking in this voice? Well, turns out, the big game was on Sunday, and I actually voiced my very first big game ad. Not allowed to say Super Bowl. You have to say big game. Not sure why. I guess the NFL might sue you. But I did. I actually did a Super Bowl ad. I don't know where it aired, if it even aired.
I think I saw it. Was it the menopause ad? Was it
that was the one.
Jesus ad, or was it the one for the Chinese retailer who's selling stuff to girls?
Is that what that one was? Was that a Chinese retailer?
I have no idea why the Chinese are pushing in the U.S. market. But
aired during the big game.
Okay.
I think it is more of an online thing, but it was for Sweetwater Lager, a lovely little brewery out of Atlanta, Georgia.
How long is it going to take you to drink up the trade on that one?
I know. I didn't. I wanted to get. I told them I will take it in beer.
Beer for voice.
But if you want to see my very first ever Super Bowl ad, just go to donmcdonald.com. I have it right there on my personal website, donmcdonald.com.
I think all joking aside, that's a big deal. So
it was fun to do because I got to play this guy, the cowboy kind of guy. It's the Sam Elliott read.
I still think you do a better in a world where one man stands alone.
In a world.
Like that, yeah.
And by the way, this mic I'm using right now, which no one can see.
In the world mic?
This is the one that the announcers use when they want that voice. Yeah. It's a Sennheiser MKH 416, as I've talked about on previous mic-a-thons here on Talking Real Money Weekends. Anyway, welcome to Talking Real Money just every day. I'm Don McDonald in the normal Don McDonald radio studios in Florida. Tom, of course, likes to hang out with planes. He's just a plain kind of guy.
Very much
a plain old American. Just hanging out in the aircraft museum. And we're here to try to shed some light on the mad, mad world of money. And today, we have an interesting topic for you. One that I had never expected we would share. But the question, it's raised by a new book, and the question is thus, feeling very Shakespearean, and the question is thus. Why, after 300 years of financial and investing advice, are we not all wealthy? Tom?
Which I think it's a fair question. The book is Invested, How 3 Centuries of Stock Market Advice Reshaped Our Money, Markets, and Mind. And then the author of this review goes on to say the advice in most cases is pretty much the same. They go all the way back to 1761.
What was there to invest in 1761?
Apparently something. Thomas Mortimer penned Every Man His Own Broker, which I thought you wrote the foreword for. Apparently not, though.
Every man his own. After this many years, the brain starts to go. And
by the way, it was 5 editions. 5 editions. Yeah.
What is there to talk about? Okay, I got to look up.
Okay,
stocks.
You're gonna. Yeah, guess what? His take, Thomas Mortimer. Experts are rather overrated. And maybe you need to say that in your British accent.
What was the quote again? Oh, experts are overrated.
Yes, that's Every Man His Own Broker. Then you move on to Thomas, apparently a popular name, Fortune's book, Epitome of the Stocks and Public Funds, published in 1796. 17 editions of that one. Again, created a whole new arena for financial writers. And but if that wasn't good enough, you could read the how about this one? A Short, Sure Guide to Railway Speculation.
Oh, well, there we have it.
That's some real money.
That's where this guy hangs out. He hangs out in that world.
Yeah. You got a whole bunch of those stock certificates hanging on the wall, do you? And then another appropriate name, Moses Smith's Plain Truths About Stock Speculation. Then you start to move into the more modern era. I know there's not a lot of you that followed things that closely in the late 19th century. But Burton Malkill's A Random Walk Down Wall Street, of course, you know that, et cetera, et cetera. But, okay, what has stood the test of time? That's what the author asks, which this is kind of interesting because I think this is very debatable. The first one, the author says, is when interest rates are high, you need stock markets less than when rates are low. In other words, you can invest in bonds and cash-like things and make money, and you don't need to be in stocks. Now, that is a very silly notion for a variety of reasons, including when do you switch from one to another?
Well, you're being really nice using the word silly. That's just stupid advice.
Kind of.
I'm going to call it like it is. Oh, by the way, before you go on with your other points,
yes.
Did you know there
Probably
were
not.
5 global bear markets in the 1700s?
Because the tulips were all the way back to like the 1500s, right? Or 15th century or
But if you invested prior to 1700, there was only one stock. There was only one.
Was General Electric? No kidding.
The Dutch West India Company.
Oh yeah, which went up, it went down, it went sideways, and it's gone. So
no, I think it still exists.
Can you still buy that one?
I believe you can. Yes,
longest running portfolio of all time.
I do believe you can.
Yeah. Okay. Well, but let's finish the thought here.
All right, go ahead.
The interest rates are high. Stock markets need less. Why is that silly? I mean, it's silly to me for a variety of reasons, including who knows one's going to be one or one the other. But your take is?
My take is that it's market timing.
Yeah.
It's just market timing. No, you want to be in both because they serve different purposes. And the other thing that's silly about it is that bonds tend to have very high yields in periods of high interest rates or high inflation.
And guess what? That means they don't do very well in terms of real returns.
Real return. I mean, I meant to say inflation, not high. High rates are high in periods of inflation like they are now. I mean, right now we have inflation at 6.4% is the annualized number. And the best yield you can get on an absolutely safe government bond is about 5%.
There you go.
Therefore, you are absolutely losing 1.4% per year. So why are they better for you?
Yeah, I think that's very fair. He also says the other big takeaway, you'll like this one, keep your costs low. And he talks about John Bogle's little book of common sense investing, which I think is a very good book for people that want to understand this business. And I think that's been around for like 30 years or something. So it's even that one's getting a little long in the tooth. Keep your costs low. I think that's a good one. Look for value. And talks about Benjamin Graham's definitive book on value investing. And here's a great one, Don, for you, Diversify. Talks about how
we agree with that.
Well, this goes back to 1870. The book is Guide to Investing Money. Bond investors should divide their holdings among Turkish, Italian, Spanish, Egyptian, and Argentine loans. Now, that's not the advice we would give you today, but still, diversification of investments is I got to think that through. Turkey probably not doing very well. Italy hasn't for a long time.
When was this advice given?
1870.
Wait, let's go through them. Let's see. Wait, I can take care of all these. Turkey was the Ottoman Empire.
I know it wasn't. Italy was Italy, but I don't think it was doing particularly well.
Turkey was the Ottoman Empire, and it was defeated in World War I and went broke. Italy was part of the Axis. They went broke.
Spain had the Philippines and all that taken from them about that time, right? 1870, something like that. No,
actually, 1898 was when we went to war with Spain.
Yep.
So that didn't go well. Egypt
hasn't been that good for about 1,500 years or something, right? It's been a long time.
Something like that. Yeah. Very long time.
Yeah. And Argentina, I don't know when they really had their golden moment.
They've defaulted multiple times on their debt.
We do have some wonderful 99-year Argentinian bonds we could load you up on.
Oh, and by the way, the Dutch West India Company did fail in the 1750s.
Oh, that's a shame. I was really looking forward to my dividend from them. The other one, and this is really actually pretty important, and I'm glad that they touched on this. Think long-term and keep your emotions in check. Wow, that takes a lot of
okay, so we read this whole book for that.
I did not read the whole book, actually.
No, but if we read it, it was hypothetical. We read it. We might have read this book and wasted all this time for that one little tidbit.
No, I like value. I like value. I like diversifying.
No, but their diversification was bad advice. It was like buy Egypt and Argentina.
We'll come back in 30 years and see if it was right or not. Okay, but there's a few takeaways. Number one, which they don't talk about in here. which I think is silly. And again, most people, when they think about investing, think they need to what? Beat the market. I got to do more. Why don't they just talk about owning all a global portfolio and taking the returns from there? Number two, ridiculous that the first suggestion is that a timing strategy will sort of do you well in good markets and bad. Nobody has that strategy that's done well in the past. Not at all. And then I thought that you could, and maybe we can get some advice from you, Don, the books that if you had to pick a few books today, which ones would they be to help a general invest? Oh, there's book out. John Bogle's books are good.
Yeah, but why? Here's my point is, why bother with them when the message is simply this: diversify globally, build a portfolio for your risk tolerance, and control your emotions. There you go.
No,
that's the whole book.
Keep your costs low. Keep your costs low.
Oh, keep costs low. 4 things. That's it. Okay. We're done.
Wait, well, that's a 4-page book. You could put one on each page, and there you go.
That's a 1-page book with bullet points.
With bullet points. Not supposed to put bullet points. Any rate,
wait, you make all these
I know. I'm the first to admit that I'm wrong.
Declarations.
Well, no, bullet points interrupt your thoughts. That they say just to have a regular paragraph.
Who is they?
I don't know. Somebody who's smarter than me came up with that. So,
how do you know they were smarter than you?
Well, that's a good point, by the way. I assume.
If you read something somewhere, you just say, "Oh, I believe this person."
I believe everything I read, and I just wrote that down. So the reality here is, they forget one other part of all this about the getting rich thing.
Mm-hmm.
There's this whole other part of investing is what half of us don't do. We don't save anything. You got to save something first to invest it, right? You got to have the discipline to do that
5 bullet
first.
points now.
You got to do that first. Okay.
Just to let you know, I have to follow up because this is important. For most of the 1700s,
yes, from a period you're familiar with, yes.
A globally diversified portfolio consisted of 6 companies.
6?
Yeah. It wasn't until the 1800s that the number of stocks increased into the hundreds.
Wow.
And when was the biggest global bear market of all time? You'll never get this one right.
The Panic of 1892.
I don't even know if there was one of those.
Yeah, there was a panic.
Okay, the worst bear market in global history.
Yes,
was the crash of 1719.
1719?
Yeah, where the global index fell 89%.
That was a bad year, man. Wow.
Second worst was 1929.
Wow. Okay. Well, a little more familiar.
So
second one's less than 100 years ago. Not even that.
Right. So it looks like if you extrapolate that out, 1929, 21, 29, 22.
We're due for something, is what you're saying?
We're due in about 2219.
22. Oh, okay. So I'm okay then. I'm selfish. I'm not worried about everybody else, but I don't want it to happen in my lifetime.
So my prediction is the next major crash will come in 2219. That's my prediction.
All right. Well, we'll hang on for that. So got time for a quick question or two here?
I always have time for questions.
Well, this one comes from your friend.
I love me some questions.
Your friend Merv from Colorado.
No, we are not taking. No.
I'm reading it anyway.
No more Merv questions.
This isn't one of the crypto or why he hates Don.
All right.
This is a lot better than that.
Is he going to call me names again?
Nope.
Okay.
Nope. This is
right.
Merv writes, with all of this talk in the media about raising the debt ceiling, I think I should get a little smarter about what's in play. I learned the total government debt has been steadily increasing since the 1980s. It appears debt has been manageable as the Fed has pushed down interest rates over the same period. So if the debt is going to continue increasing, interest rates are going to increase. What is the Fed going to do to raise it? What about my retirement savings, increasing taxes, et cetera? Should I be worried about the fact that I think the U.S. national debt sits at somewhere around $31 trillion? Should I not invest in this country, in stocks, et cetera, et cetera? So here's the good news for you, Don. The very good news.
What's the good news?
I don't even have to ask you this question. I can ask our friends at Dimensional Funds instead.
DFA answered it for us?
Yes, they did. Very kindly.
DFA all the way.
So they said, okay, first of all, the U.S. has been around for 245 years. There's only been 2 years the United States has not been in debt.
Right.
Yeah.
Mm-hmm.
What makes this somewhat significant is it does represent the debt limit or debt ceiling, something that's been faced numerous times.
Correct.
Yeah. Evidence suggests there is not a correlation between country debt and equity market returns. Let me say that again. Evidence, and these are people just making this stuff up, not making this stuff up, suggests there has not been a strong correlation between country debt and equity market returns.
That is, as a matter of fact, is absolutely true, because I was just looking at a chart of returns for global markets, and there have been years in which the best returning market is like Belgium, and they have more debt per capita than we do.
That's the key, per GDP. By the way, they also say whether it be debt, economic growth, inflation, or interest rates, here's the important part out of all this. We believe market prices quickly incorporate information and expectations. In other words, that is, as we say, baked into the cake. It's already in the prices of those equities. You can't expect a major surprise, therefore, as a result.
I think this is the hardest concept for everyone, our listeners included, for everyone to grasp. And that is this concept of the feeling. I feel like oh my gosh, what if these things happen? Well, remember, you're not the only one watching the nightly news or reading the newspaper.
There's only a couple other, but okay.
Yeah. And so you're not the only one who knows what might be happening in the future. And markets are incredibly adept at pricing that information in today, which is one of the biggest reasons why we get these calls a lot. Well, we just went into a recession. Why is the stock market going up? Because the stock market had been going down prior to the recession, having factored it into prices already.
Bingo. Yeah, great answer. All right, this comes from Carter in Janesville, Wisconsin. Don't know Janesville.
Well, it's right next to Jacksville.
I know Jamestown, but not Janesville. Okay, he says...
No, that's Jamestown.
Oh, pardon me.
Jamestown.
Well, James, she should have one too. He's got one, she should have one.
Mm-hmm. Only fair.
Carter says, I'm 18 years old. Hey, thanks for listening. Going to college, working full-time through that. Wow, now there's ambition, okay? Going to college, working full-time. I love that. Has a brokerage that's invested in SWPPX and VOO. Got a Roth IRA with $12,000 invested in VOO and VOOG, and as an employee-sponsored Roth 401k in DFFVX. What do you think? Well, first of all, the brokerage account in SWPPX and VOO, I got a problem with that. Mm-hmm. Because those are two funds.
They're the same darn thing.
It's the Standard & Poor's 500. Mm-hmm. So not liking that. He even says, do you think I should be more diversified? Yeah, pretty much you should be. And then the Roth in VOO and VOOG. I didn't get a chance to look up VOOG, which I don't know off the top of my head.
That's the S&P growth component.
Okay, so we're just getting...
So it's the wrong side of the S&P for us.
Yeah.
It's the growth side. It's the one that has done best over the past decade.
There you go, which it has, sure.
Has done best.
Yeah. Okay, if very quickly, on the Roth with $12,000, I would put that in AVGE.
Ooh, let me tell you a little something interesting. Would you like to hear an interesting story about AVGE?
Uh-oh. Did it go bust over the weekend? I wasn't paying attention.
I have a friend, and they have an account at Merrill for some reason. I don't know why. But they said, what can we put our money in? And I said, AVGE. They're young and aggressive.
Yep, sure.
They went to order AVGE, and Merrill has it as a restricted ETF. They're not allowed to purchase it in a Merrill Lynch account.
We don't know why.
I don't know why. She said, is there anything else you can suggest? I said VT, and they went, okay, that worked.
Or VBR, which wouldn't be global, though. VT would be global. You know what? I know people at Merrill Lynch. I will find out.
Do you? Good for you.
I do.
Look at that. Tom follows up.
Well, I always have plan B. So if it doesn't work out for Tom and Don, I'm ready to go.
An 18-year-old, wasn't one of those funds a DFA, a government bond fund?
No, that's not.
What was the DFF?
DFFVX, that's their small value fund.
Oh, I typed in G. Okay. I typed in
The point of the matter is you're all in U.S. stocks. You're mainly in large U.S. stocks. So you're kind of on the wrong, as Don said, wrong side of the aisle, tracks, whatever you want to call it. So we would prefer to see you redo that. The Roth especially should be the most aggressive.
AVGE and AVUV.
AVUV if you had to. So there's be some changes there. The brokerage, again, maybe what you do is you add money to the brokerage. You could, if you have gains in those two funds, you'd start adding other funds. You add U.S. small cap value, as Don just said, AVUV. You add international. There's stuff you could add there that would give you greater diversification. But I will say this, at 18, I think it's awesome that you're going to school and you're working full time. Wow, I had a lot to admire there. And that you're saving. Because at 18, who even really thinks about that at 8? No, I didn't. I can tell you that much. I've had my mind on other things.
Can you imagine how comfortable our retirements would be looking right now?
I hate to say it, but I wouldn't be talking to you right now. I don't.
Yeah, you would. You just love it that much. You do. You do. You're a glutton.
I'm calling Merrill Lynch. You're a glutton for
punishment.
I'm calling right now.
We'll call them at Avantis. Maybe Avantis doesn't know. Hey, Avantis, why did they blackball your fund?
At Merrill, we should ask. I will ask them too. Actually.
Okay. All right.
That's interesting.
All right. Do you have anything that you'd like to pitch?
I don't really have the reality is the pitch has gone very well. And we've talked to a lot of people in the first, 6 weeks of the year. Always welcome to call us or ask for help. So I'm not pitching much because we're already busy, but glad to talk to you whenever you want to, of course.
Oh, and by the way, retirement's coming up last weekend of February.
The virtual version still has seats.
The virtual version has lots of seats available, so you can sign up for that for free at retiremeet.com. Or visit us at talkingrealmoney.com for all the good stuff. There's a lot of good stuff there. We even have articles there now and stuff.
Beautiful looking site.
Great
well
place.
Done, sir.
Go visit. I'm Don. That's Tom. We're out of here because we got to spend another day talking real money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial product or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?